please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Okay, 30 points lower on the Nifty, 10,380 is where we are at. PNB is under 100 rupees today, and the PSU Bank Index is, of course, not as buoyant as we saw what we had last couple of days. Ashwini Gujral is with us. Ashwini, thanks very much. Good to have you here. Your reading of things. Nifty first.
See, it's typical sideways market. Yesterday from the lows we rallied. Today at the highs we couldn't get further traction. Now what's interesting is in the last half an hour, almost all banks and financials have come off the highs, and the Bank Nifty is basically down 80-85 points. ICICI Bank and other PSU banks are looking lower. So my sense is that maybe in the second half the banks could drop some more. So right now I think both on the index, Nifty, Bank Nifty, the right thing to do is probably to take short positions, because in a sideways market you either go to one end of the range or to the other end of the range. Now that we can't break on the upside, possibly people who went long yesterday and carried positions, etc., they could lighten up. Having said that, there are certain things which are moving up, particularly PSU space in terms of Hind Copper, Shipping Corporation, RCF, those sort of stocks are going up. So today you can buy into Hind Copper. That's a buy with a stop of 66, target of 78. Thomas Cook is a buy with a stop of 278, target of 300. And LIC Housing is a buy with a stop of 519, target of 540.
Okay, well, Ashwini, let's get in some Twitter queries then. First up, Sanjay has 400 shares of MOIL at 212, wants to know if he should hold or sell.
See, MOIL is now trading below its 200-day moving average, not as strong as it used to be. Even when the metals have come back, MOIL does not rally with the metal stocks. So maybe a better stock is to move into a Vedanta, because while there is still upside on metals, it may not be across the board, and maybe the larger players do a bit better.
Okay. One more, Ramesh wants to know if he can buy Bajaj Finance and Godrej Properties at current price levels for a period of 1 year. So his time horizon is a year.
See, he can buy it for next 1 year, but he needs to understand that the cycle of declining rates is probably over. So now when the next cycle of rate decline start, the big money will be made only at that time on NBFCs. So while it's near support and it's bottomed out, etc., I think he should be looking for targets closer to 2000. Stop he can place around 1600. And also Godrej Properties, I think it's a good time to get into that stock. It's corrected. Keep a stop around 700, and I think you should get 1,000 rupees in 1 year's time.
All right, Ashwini, thanks very much. Appreciate you coming in with that perspective, those trades, and this advice. I mean, the market is we're down 26, 27 odd points. 10,384 is where things are at. Okay, we are shifting focus to commodities. Aurobindo Prasad Gyan, Vice President Research, Kotak, is now joining in with some trades. Aurobindo, thanks for joining in.
Yeah,
what's top of mind as far as commodities go?
Well, I think we are seeing a bit of rebounding in gold prices have been in market with support from the global perspective also. And from the intraday trading perspective, or maybe very, very short-term trading perspective, we can think of buying from a bit of lower level, around 30,000, 350, 400 levels for the current contract to buy it. And we can have a target of almost 1.5%. So we can have a target of 30,000, 550, 600 levels. It's basically for intraday. Besides that, I think crude oil is something that has been actually bearish for a couple of trading sessions now. So I think we continue to hold that bearish view. And we can go short on rise on crude oil for the short. Yeah.
Okay. All right, Aurobindo, we're going to leave it on that note. Thanks very much for joining in and filling us in with those commodity strategies. Need to take a break now. But up next, we'll be discussing the fundamentals of the market and in particular one report. Well, Rahul Arora, CEO of Nirmal Bang Institutional Equities, joins in to discuss what is his latest report. And I'm sure everybody is interested in that. Live to Eat, the Indian food sector. They're initiating coverage on a couple of stocks. And the reason is that the Indian food scene has exploded in the past few years. There's digitization and social media. We all know about the Scootsees and the Swiggies of the world. So I think they're putting all of this into context in terms of what kind of opportunity it might be going forward. So Rahul, thanks for joining in. Put it into perspective for us. Where is the opportunity to make money in the food sector and why?
So thanks for having me, and I can assure you the title has nothing to do with the fact that I'm a Punjabi, where we say live to eat. But that being said, I think we actually believe that the volume growth has bottomed out for the sector as a whole. So we've been positive on the QSRs in the past. So and then we started looking at staples as a whole, wherein we were very positive on names like Lever and Gillette. And we spent the last few months actually doing a lot of ground research on how the staples in the FMCG universe are actually doing on the food side. And ex-ITC actually, because bulk of their revenues is cigarettes and they're trying to diversify into foods, we actually found that the sales and the EBITDA and the profit growth is actually higher than the home and personal care segment in the FMCG staples universe, and by almost 200 to 300 basis points on each parameter. So if you look at the sales CAGR that we're expecting over the next 3 years, EBITDA and the PAT CAGR, all of these will be at least 200 to 400 basis points higher than what we're expecting for, say, something like a Lever or a Gillette or a Dabur or a Colgate for that matter. I think there's a very strong margin expansion story in play because of premiumization. Like I said, one very big takeaway we had from our ground research was that volume growth has bottomed out. And while valuations for the stocks that we have covered in this report, ex-ITC, have traditionally always been rich, we think that, because you're at the cusp of a volume recovery with premiumization, these valuations may sustain or even go higher given the current liquidity conditions in the market. So I think overall it's a very positive view on the sector. Our top picks would be Nestle and Britannia, and we have a hold on GSK Consumer and ITC. It's a good time to get into the first two names that I mentioned.
Rahul, you already had coverage on the sector before? Or, I mean, this is a new analyst coming in, hence coverage. What's happening?
It's a change of analyst. In fact, if you go back to the history of Britannia at my firm, you'll probably, prior to this report, it was one of the worst calls my brokerage has ever given out. Because I remember initiating at the stock at about $700 or $800, and we had a target of about $500-600 back then. Okay. Sort of became a multi-bagger. Obviously, things have changed with Varun Berry coming in dramatically over the years. I think there is, in fact, we hosted him very recently, and there's a very big margin profile that that has changed in the company. When we looked at it the first time, the gross margins of Britannia in the food industry, rather in FMCG as a whole, was one of the lowest. Which left it very vulnerable to raw material cost movements, where, if you had an adverse year, you could actually get an EPS decline rather than the rate of growth coming down. But I think a lot of things have gone right. One is, of course, commodity costs have been in favor for a lot of Mr. Varun Berry's tenure, which was probably not the case when Ms. Vinita Bali was in charge. But I think he has done certain right things in terms of addressing markets, distribution, absolutely premiumization. In fact, his most recent product, I would encourage you to try it, which is Deuce, which is, a takeoff on Pure Magic. It's a pack of about 6 for $30. So the point is they are premiumizing. We're expecting about a 300 basis point margin expansion. Coming to you at about 37 times. We valued it at 45 to give you about a 25% kind of an upside.
The market is, right there, no real change to report. 23 odd points lower, 10,386 is where we are at. The mid-cap index is holding, things higher for the broader indices, about 0.6% gains there. The Bank Nifty is down 0.18%. Rahul Arora is with us. We're discussing essentially the initiation in the food space, the FMCG space, the staples space, and we were discussing out a couple of names. Rahul, but what's the most interesting, exciting, absolute return story, according to you, now in that space?
In FMCG or just foods?
FMCG plus foods. One name.
I think the highest delta in terms of earnings will probably still come from Jubilant FoodWorks, if you look at it across the board, because the operating leverage, according to me, is the most phenomenal in that. Second to that, I'd probably say Nestle. Third to that, I'll probably be HUL. and fourth in that list would probably be Britannia. I'd rank it that way in terms of, if you're looking at it in terms of absolute earnings growth potential and the way I think the stock prices would pan out. We have roughly about a 20 to 25% upside on Britannia, Nestle, Jubilant FoodWorks and HUL. In fact, interestingly, if you analyze the results of the larger FMCG companies, it might have gone, I don't know if the point is lost on anyone, but Lever on its base has actually grown its operating profit by 20% for 2 quarters running, which is very few, if any, of the FMCG companies have done it. Imami has been struggling a bit. I don't know if Kesh King was...
Patanjali jibes are working,
not just that, I don't know if Kesh King was a very big, I don't know if it panned out for them the way they were expecting. I think Colgate's volume growth is taking a little longer than expected. I'm being an internal bull. I hold the stock personally as well, but I think that's a bit of an issue. But I think Nestle, if you look at...
I mean, actually, amongst these players, Colgate, for the brand it has, the MNC pedigree, etc., I mean, it's done actually terribly over the last, couple of years now. Just in terms of business and growing their profits, market share. Actually, they're losing market share.
Well, they did, but I wouldn't be too fussed about that, because if you go back to the split price, the pre-bonus price that they had, we had actually initiated on this company the first time at 1250. So the stock had gone to about 2200 before it started correcting. There was a bit of market share loss, but inherently when you have such an aggressive competitor coming in, the guy with the highest market share traditionally will tend to lose out, which is what happened to Hero as well in the case of Honda. So I think, but the fact that they've managed to arrest that fall and they're still holding about 55% doesn't fuss me too much. I think there are still very strong. I think the story by and large, Prashant, in FMCG is not so much about a double-digit volume growth as it is about cost control, improving operating margins and the bottom line growth. So just to give you a case in point about Britannia and Nestle, since we've covered that in this report, we're expecting about 300 basis point margin improvement in Britannia and a 25% earnings growth. But if you look at my top line growth over the next couple of years, it will just be about 12-13%. Similarly for Nestle, I don't think we're expecting much more of a top line growth, but the margin expansion will be about 150-170 basis points, driving about a 18-19% kind of profit growth and a 10% increase in ROE, ROCs. So you're talking about going into the, sort of the upper 40s, lower 50s in terms of the return ratios. Nestle is coming to you at 40 times. DMart is coming to you much more expensive than that on that base. Can you ascribe a 50x? It sounds absurd to put it on that, but given the liquidity conditions in the market, you may be able to do it. So I think just from in your specific question on where you see the absolute delta coming in, I don't think anything is as beautiful as Jubilant FoodWorks still, if they're able to deliver.
What's your target price?
I don't exactly remember, but I think it's about a 20-25% upside from here is what I think, because the base effect will kick in. The same SSG will not continue. And I think the thing that people need to understand about Jubilant FoodWorks is for the obsession with double-digit SSG needs to go away, because your inflation itself is at 4-5%. So if you're giving me 7-8-9% consistent SSG, I'm home. And this, like I keep making the point, this was a company that used to operate at 60% plus ROE, ROCs that dropped down to single digits. So if they even get back to the halfway mark, I don't think that delta you will get in staples, whether no matter how positive I am on a P&G, Colgate, Nestle, Britannia, the kind of delta that business will give you, I don't think some of these names will give.
Okay, absolutely static in terms of movement for the markets. What really stands out is that the advanced decline ratio is being maintained at this point in time. So we have around 1,350 stocks advancing, 650 odd stocks declining on the National Stock Exchange. If you're just talking about frontliners, there are a couple of stocks which are losing. So for example, TCS not had a great week because of that large trade, but nonetheless, it is down around 0.7% today as well. And we have something like an ICICI Bank, which is losing out a little bit. It's done fairly well on a week-to-date basis, but down around 1.2% at this point.